The Cannon Equity Fund aims to deliver sustainable growth over 3 to 5 years through exposure to listed equities. Now, to talk on that fund and its top holdings, we're joined in the studio by Andrew Newell, who's Head of Business Development at Cannon. Hi, Andrew.
Hello, David.
I've got a little quote from one of your circulars which says, "The past 3 years represent a difficult period for true value managers." Now, that sounds like a good topic for a third-year university essay. Discuss.
And for the time that we have this evening, I think the point we're making there is since the financial crisis, so from 2009 onwards, what we've seen is a hunt for growth. There's been a lot of uncertainty in the world, and people are or have been hankering after the next great story. I know most of the show you've been talking, or a lot of the show you've been talking about Europe. Where to next? And I think equity markets were no different for the last few years. Is there going to be corporate success in the developed world, or isn't there? Do we all go to China and India, or don't we? And we saw that in equity prices. So, for instance, our definition of value investing is attractively priced assets, historically, that are of decent quality. Now, where we saw all of the action for the last few years has been in companies that were quite expensively priced initially and got more expensively priced as time went on.
When you say you're looking for growth, it's visible growth now. People are panicking because they're not seeing any movement. So whereas a value manager would say, well, we don't actually need the growth now. We're looking for shares that will grow in the long term. But of course, you're under pressure.
Sure. What we're saying is we're looking actually for the price of the shares to re-rate to what is a more reasonable level. And that will come through a company delivering sound earnings. It doesn't have to be shoot the lights out at all, just decent. When we talk about growth, we are looking to where fund managers are very forward looking. So companies that have done well and continue to do well would be the likes of our big industrials, Richemont, Naspers, Massmart, of course, with the Walmart transaction, and they've all done superbly well. Now, the emphasis there is what will they do tomorrow? So what will Tencent deliver and feed back into Naspers? Where will breweries deliver in their next emerging market expansion, for instance?
Yeah.
Our view is it's very difficult to see that, and as a result, what we prefer to do as a value manager is to say, where's this company positioned from a price perspective today, and where has it been over its past? If it's attractive today and it's a sound company, it will catch up to its long-term average.
Yeah. Andrew, when you're talking about the value proposition, you keep referring to this idea you want to buy not just cheap companies, but sound companies.
Yes.
To what extent are you able to find value companies now that you would also regard as being, good quality, a good quality company? Is it fairly easy at the moment, or is it sort of slim pickings?
It's relatively easy, and the reason I make that point is, or that claim is, at Cannon our investment universe is very wide, and so if you're looking at your top 40 to 60 companies, say by market cap, a lot of them are good quality, and a lot of them have run very hard. As a result, they are good quality but not value propositions. There are some which remain value opportunities and are well managed and increasingly so. Anglo-American, we think, is an example. But further down into the market cap, you've got some mid and small cap counters which are very sound businesses but have just been neglected for various reasons. Either they're smaller.
Sorry to interrupt. How do you differentiate between a sector being out of favor, and I would argue that resources have been somewhat out of favor, versus a value share? I could argue that Anglo represents or presents as a value share simply because the resource sector is somewhat out of favor. Is it that you just, when I look at your top 10 holdings, we were commenting early on that you've got a lot of resource companies in it. To what extent are you just putting resource companies in your portfolio because the sector has been out of favor?
Perhaps I'll try and make this relatively concise. The first point is, how much do we want in each of the super sectors, resources, financials, and industrials? And we look at those relative to one another, so they don't need to be absolutely cheap, but they need to be more attractive than the rest.
So if you're looking at industries that are cyclical, like resources can be cyclical, construction is almost by definition cyclical, the way it works. Big companies that do big things and then have no work, and then have to start again.
Feast or famine.
And you like the construction sector, so it comes back again to Kevin's point. A sector like that almost offers value by definition because people are reluctant to see it because they don't like the volatility.
No, I don't agree. It
You
offers
don't?
value now, but because it's cyclical, you must identify when it no longer offers value. So if I come back to your resources question, the sector has lagged, and as a result, relative to financials and industrials, it's relatively attractive.
Okay.
Point two, or step two, is inside that cluster. Does that mean all resources are attractive? No.
Okay.
You then need to go down to the stock level and say which of these resources are more attractive. Anglos versus Billiton. We think Billiton is a great business, as is Anglos. Billiton is more expensive than Anglo, so we take our exposure through Anglo American, not Billiton. The number of resources counters we have, and perhaps this is a different answer to your question, the number of counters we have is relatively small in the fund, but the exposure of the whole sector is quite high.
Sure.
So what that tells you is the individual weights to each of those stocks is relatively high. Anglo-American is in the order of 12 and 13%, for instance. Sasol also very high. So the specific, or the exposure we've taken is very specific and often different.
We'll talk about your top 10 in a moment, but looking, as we've been doing earlier tonight, the things that are going on in Europe, every day, people talk about, are we out of the woods? And of course they're not. Greece, Italy, Portugal, whatever. And the United States, recovery struggling to get going. What do you make of that from the perspective that you've just outlined? What guides you at the moment in these markets?
I'll try not to cop out of the question, but what we specifically try and avoid is taking a macro view or a world forecast. So where is America going and what's going to happen in France and will Germany follow? We don't know.
Which is tempting to do, but you don't.
It's probably the most interesting thing to talk about, but it's the most commonly incorrectly forecasted thing. So are we looking at resources because we see economic recovery and China is going to carry on growing at 8, 9 and 10%? No, that's not why we've bought resources. The reason we've bought resources is in the South African context, they are more attractive than financials and industrials.
But then the follow-up is what unlocks that value.
Okay, so
what's the catalyst for Anglo to re-rate?
Right, so there you need to be quite specific in your stocks. The thing we like about Anglos is about 3/4 of their revenue is derived from base and bulk metals. The demanders of those ingredients principally are China, India, and the like. So if you're looking for an economic sort of backbone or where economic growth will be sound or better, that's probably where it will be, and that offers support to Anglos. That's the short answer.
Yeah. Let's look at some of your stocks. You've got Sasol on the top, and we were talking earlier, oil price is down, it's gone down from over 120 to 112, I think, today. Sasol tracks that. Why Sasol?
The thing we like about Sasol is the technology they have, and we think that gives them a competitive advantage. So
unique in the world.
It is. And for all of their issues and competition threats every now and again, we still think that it has a really strong foothold and competitive edge. And so we continue to like the firm. Good cash. This is something which will play out for many, many years. It's not going to suddenly move up tomorrow, but we think it's very attractively priced. So you could move towards the order of 500 Rand, we think.
Within the sectors that have run hard, so some of the big industrials, some of the retailers, do you find any value in any of the counters there?
You said big industrials? So then no.
No, okay.
You will have to look very hard to find value. And I mean, that's a really interesting sector to look at, because if you look at the divergence between the large sort of big 20, 25 industrials and the rest, the valuation gap is alarming. So if you look at the usual suspects of the Richemonts and breweries, Naspers and so on, they are priced on through the cycle earnings multiples of about 20 times, which is far in excess of an average 16. And conversely, the rest, your more South African oriented firms, are on multiples through the cycle of about 12 or 12 and a half. So not only is one absolutely expensive and one absolutely attractive, but relative to one another, there's a big dislocation. So where we are not invested is the headline retailers, Woolies, Foschini, Truworths and the like. Wonderful businesses and they deserve some kind of a premium, but we think they've run too hard. What we do like are companies that generally are South African focused. David, you mentioned construction. We can talk about that a bit later. Some of the IT firms are very interesting to us. Pinnacle Technology has run very well, but is still attractively priced. Earnings do very nicely. Metair.
It strikes me that you've got names that everyone knows in the world, and then there are other names that people say, hang on, what's that again? What are they in? And like furniture. I mean, you've got Sasol on the one, and you've got Steinhoff and Lewis. So those are two consumer-exposed groups that you do like.
Yes. Lewis is interesting because what they really do, and I don't think this is a story unique to Canon at all, but they lend credit, and when you walk out the shop, you happen to have a loan agreement and a lazy boy couch and a wall unit. The wall unit is there to get you in the store to sign some kind of a loan facility. What they do very well is collect on that debt. And if you price a microlender, which is effectively what they are, they're on a book multiple of about 1.8 times, which is quite attractive. If you look at some of their comparators, which are not obvious at first glance, you'd be considering Capitec. They're a microlender. So you don't.
They just don't give you a couch.
No, they just give you 10,000 rand. And you must go and find your own couch. African Bank, not dissimilar. They've got a tie-up with Ellerines, of course, but their book multiples are more than double that of Lewis. So that's quite an interesting comparator.